Hello class, so in this video, I'm gonna discuss about the 15 questions in our sample test for the final exam. So again, it will be great if you can work on these 15 questions on yourself independently before you look at the answers in our document or watch this video. Okay, and our final exam is gonna be very consistent with these 15 questions, so make sure you self-test. You test yourself by using all these 15 questions and look at the answers afterwards. Okay, so let's look at the first question here. The primary operating goal of a publicly owned firm interested in serving its stockholders should be A. Maximize sales, B. Maximize earnings, C. Minimize expenses, D. Maximize shareholder wealth, E. Maximize the stock price on a specific target date. Okay, so we discussed this question in the last chapter, chapter 13. Okay, remember when we were looking at the optimal capital structure, we want the highest stock price, P0, possible. Also want the WACC, weighted average cost of capital, possible. So from chapter 13, we could know that the primary goal of a publicly owned firm is to maximize stock price. In other words, maximize shareholder wealth. Okay? Or minimize WACC. Okay, either of these two criteria works, and they are consistent with each other. Okay, so we could say we want the highest stock price, P0, or we want the highest shareholder wealth, or we want to minimize WACC. Okay. So in other words, we can say maximize our primary goal of a firm is to maximize the long run stock price, P0, or the intrinsic value, P0, or the shareholder wealth. Okay, there are different ways to say it, but stock price or shareholder wealth is our primary goal, not sales, not earnings, not expenses, not stock price on a specific target date, but the long-term, long-run stock price. Okay. Question number 2. Let me save this file as the updated sample test. Okay, with notes. So you can download both the sample test for the final exam on Canvas. You can also download this updated sample test for final exam with notes. Question number 2. Suppose a company has just paid a dividend of $2 per share for the year ended December 31st, 2018, its last reported fiscal year. Okay, so this dividend $2 is already paid. Just paid at the end of the last year in 2018. So it should be D0 instead of D1. Okay, the company expects to grow this dividend at an annual rate of 3%. So our constant growth rate would be 3%. G is 3%. The cost of equity for this stock is 10%. Okay, RS is 10%. What is the stock price today? Okay, so here we know D0, we know G, we know RS. Okay, from these information, and we're looking for P0. So this should remind you of our constant growth model, of the dividend discount model. Okay. And because this dividend is a growing perpetuity, we know it's gonna be growing at the rate of G, 3%. So we can just use the constant growth model, P0 equals D1 over R minus G. Okay, And we don't know D1 here, but we know D1 equals D0 multiplied by 1 plus G. Okay, so D1 equals D0 multiplied by 1 plus G. D0 is $2, 1 plus G is 1 plus 3%, so we know D1 is 2.06. And we use this number divided by R, 10%, minus G, 3%. So we have 29.43 as our current stock price. Okay, so we just simply use the constant growth model for the dividend discount model. Okay, plug the numbers in of D0, R, and G. Okay, and again, for the final exam, you will see the formula sheet. If you're not, if you don't remember the formula for the constant growth model, you can go to our formula sheet for the final exam. It's gonna be in chapter 9, okay? And you'll see this formula as the first formula. Okay, question number 3. You agree to take a 2-year mortgage of $11,227 with monthly payments of $500 at the end of each month. Okay, so you are borrowing this much money today and you're gonna pay it back in 2 years, and for each month you're gonna pay back $500 at the end of each month. If the bank compounds interest monthly, what is the APR you'll be earning? Okay, so we know the present value where today, okay, it's gonna be a cash inflow for us, but for the bank, it's gonna be a cash outflow for the bank. Okay, so we can input present value as negative 11227. And for the monthly payments, it's gonna be our cash outflow, but for the bank, it's gonna be the bank's cash inflow. So we can input payments as 500 as the monthly payments and monthly income for the bank. And we know we're gonna pay back the money in the end, so future value equals to 0. And N is gonna be the number of months, okay, because payment is monthly payment, so N should be number of months. So it's gonna be 12 months per year multiplied by 2 years, so we have 24 months in total. And we solve for monthly rates. We compute, okay, compute I/Y. Okay, we compute for I/Y. We input all the other 4 variables and compute for I/Y. So we can solve for the monthly rate, and it would be 0.54 on the financial calculator. And we're gonna add back the percentage sign. Okay, but this is the monthly rate. Remember what is APR? APR is always the nominal annual interest rate. Okay, so we need to use this monthly rate 0.54% multiplied by 12 months. So we have the nominal annual interest rate as 6.48. Okay, as our nominal annual APR. Okay, APR, again, it is annual percentage rate. It's nominal annual interest rate. We can also use NOM to stand for it, okay, which means it is the nominal rate. Nominal annual rate, annual percentage rate, APR, NOM. They're all talking about the same thing, okay? And in the financial calculator, we're always solving for the periodic rate from the financial calculator. Here, we're solving for monthly rate. So you have to multiply by 12 to get the annual rate. Okay, so if you want to see me to work this question on the financial calculator, okay, let me show you here that we have an N, Okay, let me start with the PV. Okay, still start with the PV from the first information we had from the question. So I can input 11227 negative as PV, the present value I'm borrowing today, which is cash outflow for the bank. And I'm gonna pay back 500 for the bank as payments. It's cash income for the bank, monthly income. Future value is 0. N is 24, okay, as N. Compute for I. Okay, this is how we can get 0.5397, which is about 0.54 as the monthly rate. Okay, I can just clear work, input 0.54, multiply by 12. Okay, so I have 6.48% as my final answer here. Alternatively, for this question, you can also input present value as 11227. Okay, so you can work from the borrower's perspective. So 11227 is gonna be the cash inflow for the borrower as the present value, but then the payment should be negative 500. Okay, so either way works, but present value and payment should be opposite signs here. And you compute for I, you will have the same answer. Okay, so I can put negative 500 for the payment as well. But if I do that, I will have to make present value positive. Okay, the first set of choice is standing from the bank's perspective, the lender's perspective, and the second set of choice is standing from the borrower's perspective. Okay. Okay. Let's go to question 4. What would the present value of 100 be after 6 years at 10% compound interest? Okay, so we know the future value of $100 after 6 years. We know the compound interest rate. We're looking for the present value. A very simple TVM question. Okay, we can input N as 6, I as 10. Okay, remember to remove the percentage sign. Okay, let me delete the percentage sign here. So we know 10 is the number we need to input as I. Future value should be 100. You can input as negative or positive, either works. It's just the present value we solve for would have an opposite sign. Payment is 0 in this question. Okay, and we compute for PV. We should have 56.45. Okay, so we choose option B here. Very simple TVM question. Okay, so if we put future value as 100, then our solve for our PV would become negative 56.45. Okay. So here we just input N as 6, 10 as I, 100 or negative 100 as FV, 0 as payment, compute for PV. Okay, we can have 56.45 as our present value. Chapter 5 TVM question. The following information relates to the following two questions. Suppose you're buying your first condo for 145,000 and you will make a 15,000 down payment. You have arranged to finance the remainder with a 30-year monthly payment amortized mortgage at a 6.5% nominal interest rates, with the first payment due in 1 month. What will your monthly payments be? Okay, we're looking for the monthly payments. Okay, we know our total price. We know the down payments. So we know the difference between the total price and the down payments will be paid using mortgage. And this mortgage is going to be a 30-year monthly mortgage. Okay, and our nominal rate is 6.5%. It's still a time value of money question, but things get a little bit tricky here. First of all, the amount we borrow today is the gap between the total price and the down payments. So we need to use 145,000. Okay, step 1, we need to use this 145,000 minus 15000. Okay, the gap between the total price and the down payment would be 130,000. This is the money we're going to pay back using mortgage. Okay, so we can input this amount as our present value here. Either positive sign or negative sign works. Okay. And then for n, we have to input number of months. So it's 30 year multiplied by 12. We have 360 months in total. For I, we need to input monthly interest rate. So we use the nominal annual rate, 6.5%, divide by 12. Okay, let me remove the percentage sign. So we input 0.5412 as our I on the financial calculator. Okay, PV is still this number, 130,000, or negative. Future value is 0 since we're going to pay off the loan. Solve for payments. Compute for payments. We will have 821.69 as our monthly payments. Okay, if you input PV as a positive sign, then payment will show a negative sign. Okay, so if I work on my financial calculator, I'm gonna do 30 multiplied by 12 equal sign, input as n, then 6.5 divided by 12 equal sign, input as I, future present value is 100,000, input as P, let me put a negative sign, input as PV, and 0 as future values, compute for payments. So I have 821.69 as my monthly payments. Question 6, what are the total interest payments? Okay, so here we know the monthly payments for 360 months is 821.69 for each month. Okay, so in order to solve for the total interest payments, the first way to solve for this question is to go to our second amortization table. Okay, so I've already make sure you solve for the payment on your financial calculator. Then we could go to second amortization. Okay, now we know we want total interest payments over all months. So our P1, the starting period, is 1, the first month. And our P2, We want to change it to 360. Enter. Okay, so now our time period is from first month to the last month, to the last 360th month. So this way, our balance would be almost zero, meaning we will pay back all the money over 360 months. Okay, and the principal paid would be almost 130,000. This is the principal, the total principal, 130,000 we're paying back. And we keep pressing down button. We would have 165,807.86 as the total interest payment we pay back over the 360 months. Okay, so our right option would be C. Okay, so this is method 1, using the financial calculator amortization table. Another way to solve for this question is that the total payments we pay would be the each monthly payment 821.69 multiplied by 360. Okay, so let me calculate this second quit. 821.69 multiplied by 360 would be 295,808. Okay, 295,808.4. Okay, this is the total payments, total money I pay over the 360 months. And total payments consist of two parts, the repayment for principal and the repayment for interest, right? So total interest payments we look for would be equal to total payments minus total principal payment. Okay, so we can use total payments minus the total principal we need to pay, which is 130,000, the original principal we borrowed, the original money we borrowed. Okay. So I use this number minus 130,000 equals 165,808.4. Okay, it's gonna be similar to option C here. Okay, there are some little bit difference here because of the rounding, but option C would be the closest answer. Okay, so let me put 165,808.4. Okay, so either method works. In order to solve for the total interest payment, you can go to amortization table, making the sets. So keep P1 as 1 and change P2 to 360. Okay, so this means you want the total interest payments over all these 360 months. P1 is the starting month, and 360 is the ending month. Another method is to use the monthly payment multiplied by total payments equals monthly payment multiplied by total number of months. Okay, so it becomes 821 multiplied by 360. So you have the total payments, and you minus the total principal payments, 130,000. So you would have the you would have the total interest payments. So we have this method 1 and method 2. And they will bring you option C. Okay, this is chapter 5, class 4, amortization table question. Question 7. Okay, let me pull up the answers. Okay, I don't know why I have this gap in here, but I will try to pull up the answers. Okay, let me just work it this way. Question 7. The real risk-free rate is 3.05%. Inflation is expected to be 4.25% this year. And the maturity risk premium is 0, ignoring any cross-product terms. What is the equilibrium rate of return on a 1-year Treasury bond? Okay, so for this question, we know the real risk-free rate, we know inflation, we know MRP is 0. We are looking for rate of return on a 1-year Treasury bond. Okay, so here we're looking for return on a short-term Treasury bond. R should equals to R star. The real risk-free rate plus IP, okay, plus MRP. But actually in the formula, we ignored MRP because maturity risk premium is 0 for a short-term bond, okay? So we don't need MRP here. And for this bond, we already know R star. The real risk-free rate is 3.05% in this question, and we know inflation premium is 4.25% in this question. So we just add up these two numbers, and R comes 7.3%. Okay, very simple question here. You can also look at the formula sheets. Okay, the rate of return on different bonds is in chapter 6. We have the comprehensive formula of the return for corporate bond equals to R star plus IP plus DRP plus LP plus MRP. Okay, and for treasury bonds, we don't have default risk premium and liquidity premium. We only have R star, IP, and MRP. And for short-term bonds of treasury or corporate bonds, we would not have MRP here. Okay, that's chapter 7. Oh, question 7. Okay, let's look at question 8. This firm had a profit margin of 6.25%, a total assets turnover of 1.5, and an equity multiplier of 1.8. What was the firm's ROE? Okay, so we know profit margin here, we know total assets turnover here, we know equity multiplier here, we want ROE. We can just use the DuPont equation we learned in chapter 4, analysis of financial statements. ROE equals profit margin multiplied by total assets turnover, TATO, multiplied by equity multiplier, EM. So we just multiplied the three numbers. We would have option C. Okay. If you don't remember this DuPont equation, again, you can go to our formula sheets in chapter 4. Okay, here you can see ROE is return on equity. It is, by definition, net income divided by shareholders' equity. It is also profit margin PM multiplied by total assets turnover, TATO, multiplied by equity multiplier, EM. Okay, and for this question, we already know PM, TATO, and EM. So we multiply three numbers to get ROE. Chapter 4 formula. Okay, so this is question 8. Question 9. Company E and P each reported the same earnings per share, EPS, but Company E's stock trades at a higher price. Which of the following statements is correct? Okay, so we know the two firms, they have the same EPS, same earnings per share, but E's stock trades at a higher price. So Company E has a higher stock price compared to P. We want to know if Company E probably has fewer growth opportunities, or if Company E is probably judged by investors to be riskier, or Company E must have a higher stock price, a market to book ratio, or Company E must pay a lower dividend, or Company E trades at a higher PE ratio. Okay, so we know EPS, earnings per share here. We also know stock price. We can calculate PE ratio by using stock price divided by EPS. If you don't remember this, again, it is in the formula in chapter 4. Here, PE ratio equals stock price divided by earnings per share. Okay, so we can rewrite the formula here. Company E has the same earnings per share as Company P, but it also has a higher stock price. Okay, so Company E has a higher P ratio than Company P because it has the same EPS and higher stock price. And remember what P ratio means? Higher P ratio, we've discussed in chapter 4, means that investors believe the firm has higher growth opportunities and less risk. Okay, for the same amount of earnings per share, if the investors are willing to pay for higher stock price to purchase the stock, it means they think the firm has higher growth opportunities and higher risk. So a high P ratio is a good signal for the firm. So Company E has higher P ratio. Okay, we think option E is correct. For A is not correct because E should have higher growth opportunities with this higher P ratio. Option B is not correct because Company E should be less risky with this high P ratio. Option C is not correct. We don't know the market to book ratio. Okay, Company D is not correct. We don't know the dividend. Unknown information. Okay, option E is also unknown information. For option A, it should be have more growth opportunity. Option B, it should be less risky. Okay, so all of these are my corrections. Okay, this is question 9. Question 10. An investor has a 2-stock portfolio with 50,000 invested in Herbert Manufacturing and 150,000 in Biggers Corporation. Herbert's expected return is 6% and standard deviation of returns is 15%, and Biggers' expected return is 10%. What is the portfolio's expected return? Okay, so we are looking for portfolio return, and we know the portfolio consists of 2 stocks. And for each stock, we know the amount of money we invest. We also know the expected return for each stock. Remember, the expected return of a 2-stock portfolio should be the weight for each stock multiplied by the expected return for each stock. So expected return of the 2-stock portfolio is the weight of each stock multiplied by the expected return of each stock. And add them up. So the sum of weights of each stock multiplying by the expected returns of each stock. Okay, so that's the average expected return of the stock in the portfolio. So in this question, we know the expected return for the 2 stocks. We need to calculate the weight for each stock. Okay, for Herbert Manufacturing, the weight should be the 50,000 we invest in this stock divided by the total capital we invest in the portfolio, which is 50,000 plus 150,000. So we have 25% invested in Herbert, or the first stock. Okay, for the second stock, the weight should be 100% or 1 minus 25%. So we have 75% invested in the second stock. Okay, alternatively, we can use the weight for Biggers is the amount of money we invest, 150,000 in Biggers, divided by the total capital, which is 50,000 plus 150,000. Okay, so if we calculate this, we should have 0.75 as well. Okay, so we have 25% invested in the first stock, we have 75% investing in the second stock. Okay, and then we can use the weight for the first stock, 0.25, multiplied by the expected return for the first stock, 6%, which is also 0.06, plus 0.75, the weight for the second stock, multiplied by the expected return for the second stock, 10%, which is also 0.1. Okay, so we have 9% as the expected return for the portfolio. We don't need the standard deviation information for this specific question. Okay, so this is question 10, the expected return of the portfolio. You can also look at Chapter 8 formula. Here, RP means the return for portfolio. Okay, it is the weighted average of the expected returns of the stocks in the portfolio. RP equals W1R1 plus W2R2 plus WN multiplied by RN. Okay, so here I can also say the expected return of the two stock portfolio is the weighted average of the stock returns in the portfolio, which is also the sum of weights of each stock multiplying by the expected returns of each stock. Okay, and I can also put this formula in here. Formula is a little bit okay. Here we have two stocks, so we only have two items here. Okay, question 11. A has a beta of 1.2. Okay, or I can say stock A has a beta of 1.2. Stock B has a beta of 0.8. Portfolio P is a 300,000 portfolio consisting of 200,000 invested in stock A and 100,000 invested in stock B. What is the beta of the portfolio? This is very similar to question 10. The beta of the portfolio is the weighted average of the betas of the components, okay, which is also the sum of the weights for each stock multiplying by the beta of each stock. Therefore, the beta of the portfolio, again, we need to solve for the weight first. Okay, so the weight for stock A is the amount of money invested in stock A, 200,000, divided by the total money invested in the portfolio, which is 200,000 plus 100,000. Okay, so it becomes 2/3. Okay, and the weight for stock B becomes 1 minus 2/3, so it becomes 1/3. Okay, so the beta of the portfolio is 2/3, the weight for stock A, multiplied by the beta for stock A, which is 1.2, plus the weight for stock B, 1/3, multiplied by 0.8, the beta for stock B, so it's 1.07. Okay, if you want to know the formula, it is here, also in chapter 8 formula. Beta of the portfolio is the weighted average beta in the portfolio. Okay, and again, here we only have two stocks in the portfolio. So here we only have two items, W1 B1 plus W2 B2. Question 12. Which of the following statements best describes what would be expected to happen as you randomly select stocks and add them to a portfolio? Option A, adding more such stocks will reduce the portfolio's unsystematic or diversifiable risk. Option B, adding more such stocks will always reduce the portfolio's beta. Option C, adding more such stocks will certainly increase the portfolio's expected return. Option D, adding more such stocks will reduce the portfolio's market risk. Option E, adding more such stocks will have no effect on the portfolio's risk. The right answer is option A. Adding more such stocks will reduce the portfolio's unsystematic or diversifiable risk. Okay, remember we've talked about this in the sample test of the midterm 2. We've also talked about it in the notes in chapter 8, class 3, risk diversification. When we randomly select stocks and add them to a portfolio, the total risk of the portfolio goes down. Okay, because the upper part, the unsystematic risk or diversifiable risk, goes down. The bottom part on the graph, which is the market risk, remains the same as we add more stocks. Market risk cannot be diversified away by adding more stocks, but unsystematic risk or diversifiable risk can be diversified away and goes down when we add more stocks. Total risk of the portfolio also goes down. Okay, you can go back to our chapter 8 class 3 notes if you don't remember the graph or the pattern here we're talking about. Option B here. We don't know what will happen to the portfolio's beta. Okay, because portfolio beta is the weighted average of the betas in the stocks. So it depends on the old beta of the old portfolio and the beta of the newly added stocks. So the beta of the new portfolio can be larger or smaller than the old beta. Okay, so it's unknown here. Portfolio's expected return is also unknown because the expected return of the new portfolio could be larger or smaller than the expected return of the old portfolio. Okay, it depends on the return of the newly added stocks and the old stocks. Market risk. No, the market risk should remain the same. Market risk should always remain the same because it cannot be diversified away. Portfolio's risk. No, the stock's total risk or portfolio risk should decrease. As we add more stocks. The following information relates to the next 3 questions. This company is considering Project SNL, whose cash flows are shown as below. We have WACC for both projects at 7.5%, and we know the cash flow for both projects from year 0 to year 4. Okay, so we're looking for first question 13. What is the NPV for each project? Okay, this is testing our knowledge. We're learning chapter 11, capital budgeting. We can input all the cash flows of the firms in the cash flow function of the calculator, press NPV, and input I as WACC, and compute for NPV. Okay, so let me work on this on the financial calculator. Okay, let me first work on project S. Okay, I go to the cash flow function. Cash flow 0 should be 1100 negative. Enter. Down button. Cash flow 1 should be 550. Enter. Down button. Frequency 1 should be 1. Cash flow 2 should be 600. enter. Down button, frequency 2 should be 1. Cash flow 3 should be 100. Enter. Frequency 3 should be 1. Cash flow 4 should be 100. Enter. Frequency 4 should be 1. Double check there's no cash flow 5. Come back to cash flow 0. Go to MPV, input I as our WACC here, 7.5. Remove the percentage sign. Press enter. Down button. Compute MPV. So we have 86.20 for cash flow S. Okay, so option A has the right answer for S, 86.2036 as the MPV for project S. For project L, okay, you can already solve for option solve this question and choose option A based on the MPV of S. But just double check. Let's also calculate the MPV for L. Okay, then I need to change my cash flow 0 to 2700 negative. Enter. Cash flow 1 as 650. Enter. Frequency 1 as 1. Cash flow 2 as 725. Enter. Frequency 2 as 1. Cash flow 3 as 800. Enter. Frequency 3 as 1. Cash flow 4 as 1400. Enter. Frequency 4 as 1. Double check no cash flow 5. Come back to cash flow 0. Go to MPV. Input I as 7.5. Down button, MPV, compute. Okay, so for project L, we have MPV of 224.365. Okay, so again, we input all cash flows in the cash flow function, press MPV, input I as WACC 7.5, press enter, and press down button, compute for MPV. We could have the MPV for both projects here. Question number 14. We need to input all the cash flows, again in the cash flow function, press IRR compute to look for the IRR of each project. Okay, so now I have all the cash flows for L in my calculator already, so I could just go to IRR function, press compute. 10.7118 is the IRR for project L, so I know option A is the right answer. I want to double check using project S, so I have to change all the cash flows for to the cash flow of S and press IRR. So let me input cash flow 0 as 1100 negative. Enter. Cash flow 1 as 550. Enter. Cash flow 2 600. Cash flow 3 100. Cash flow 4 100. No cash flow 5. Go to IRR compute. Okay, so IRR for S is 12.2416%, which is the same as option A. Question 15. As the two projects are mutually exclusive, this firm should reject both projects, investing both projects, investing L but not S, or investing S but not L, or none of the above. So because these two projects are mutually exclusive, it means we can only choose one of them. By comparing their MPV, we know they both have positive MPV, but L has a larger MPV. So based on MPV, we should accept L because it has the highest MPV and positive MPV. Based on IRR, however, both IRR is larger than WACC, 7.5%. However, S has a higher IRR, so based on IRR, we should accept S. Okay, so we have conflicts here based on the two measures. Based on NPV, we should go with L. Based on IRR, we should go with S. And recall that NPV is a better measure compared to IRR. So we should make our final decision based on NPV and choose L. Okay, so the right option is option C. We should invest in L but not S. L has a larger NPV and a lower IRR compared to S. When NPV and IRR leads to different conclusions, we go with NPV. Okay, NPV is a better measure compared to IRR because we assume WACC is the reinvestment rate. For IRR, we assume IRR is the reinvestment rate. So the discount rate or reinvestment rate is more realistic for NPV. We think NPV is a better measure. Okay, so in this question, based on NPV, we should choose L. Based on IRR, we should choose S. But we go with NPV and choose L, not S. Okay, so this is question 15. And these are all the questions we have in the sample test for the final exam. Okay, make sure you understand all these questions and make sure even after you look at all the answers, you can go over all the questions again and make sure you can work these questions out independently by yourself. And whenever you have additional concerns, you can refer to our notes. You can also make an appointment with me by email or through Zoom conference. And I wish you good luck in your final exam.